We have been using financial reports or financial statements intensively in business, also in the industry. Those financial statements are balance sheet, income statement, cash flow statement, and then the statement of stockholders' equity. So the major four, and then we also have the notes to financial statements. I think those are the five core components in a firm's financial statements. So today we're going to discuss the financial statement analysis, and this is a big topic. I mean, in academic, if you go to a school of accounting, um, you have a lot of like courses related to financial statement analysis, and in those specific courses, you learn about the financial ratios that become the like, roots of the problem, and also like ratios that are symptoms. So we have symptoms and we have roots of the problem. So again, in accounting, you learn very deeply about the financial ratios and how to use them to conduct the financial statement analysis. But today we're going to see like a big picture, like the grand framework of financial statement analysis. So we'll see uh, like general ratios that are widely used um, in like corporations and in assessing like the conditions of a firm. And you'll see some aspects like liquidity, uh, asset, debt, profitability, and then the market. Okay, so let's go into our materials today. Okay, so we're going to use the financial ratios to do the financial statement analysis. And here, see, financial ratios could facilitate a comparison. The first one is time series, like time series analysis of a firm. Um, we can estimate and analyze a firm's time series ratios, like liquidity ratios, asset measurement ratios, and some other ratios that we are going to see. So the first comparison is the time series, and of course the second one is the cross section. So you could compare one firm against or versus other companies, or maybe the major industry in which the company is operating. So time series and cross section. So what is the main benefit of using the ratio? I think financial ratios could reduce like certain bias that we will find if we simply compare like one item over like two companies or two individuals or two entities or anything. So you could imagine uh, if I have like maybe two entities, this is the first entity, and if I check uh, the cash of the first entity, I find out that the cash of the first entity is, let's say, 1 million, 1 million. And the second entity, when I check the cash on hand of the second firm, I found out that the second firm only has like, say, 100,000. So based on like the cash comparison, it looks like, you know, firm one is much more dominant than firm two, right? Because the cash is abundant, relatively more abundant than what the second firm has. However, when I look at a more comprehensive picture, I find out that actually the current liabilities of the first firm is, let's say, 900,000, okay? Whereas the current liabilities of the second firm is, say, 5,000. So you see here, based on the simple ratio, uh, cash to current liabilities, you find out that actually the second firm has a more abundant like liquidity position, a stronger liquidity position than the first firm. So this is based on the simple ratio of cash to current liabilities. Right? So by comparing financial ratios, we can get a more, I think, more realistic and more comprehensive, right? The more panoramic picture of a firm, and also the its comparison to other firms or the industry. So ratios can be used by lenders to determine credit worthiness. Of course, right? Imagine that you are a bank. If you are a bank and one particular company comes to you to send a borrowing proposal, then you have to, of course, you have to assess, and one of the simplest indicators would be financial ratios shown by the firm. So determine credit worthiness, whether the firm is worth lending, right? So we want to find credit worthiness. Second one, we can give the information to stockholders to estimate the future cash flows and risk. Of course, by knowing the financial statements and its analysis, especially pertaining to future cash flows, the expected future cash flows, they can estimate the risk, right, of the firm based on those information. And for management, of course, for the executives, they could identify the areas of weaknesses and strength. So in a typical competitive country, we might not be able to strengthen our positions in all categories, right? Of course, if you operate in less competitive countries, you might be good at everything because you are the monopolistic or oligopolistic company or industry. Then you can dominate everything. Right? You could be strong in liquidity position, in your asset management position, in your debt management position, and also the market position. However, in a competitive country, you might have to prioritize from time to time. So there's a time you have to prioritize your liquidity position, and it will be less strong in your profitability position. Yeah, could be, or the other way around. There are times where you have to be focused on the profitability position, but a bit relaxed on, for example, your liquidity position. So we could identify the areas of or your weaknesses and your strength. Okay, so today we're going to use the hypothetical financial statements. This is our hypothetical income statement, and then balance sheets, other data. So we'll begin with the first category. So the first category is liquidity ratios. So you see the name here, as the name suggests, liquidity. This is your liquid position, right? Your current position. So can you meet your liabilities, short-term liabilities, using your resources, especially your short-term assets? So again, this ratio measures how strong or how good you are in fulfilling your short-term liabilities, right? Whether you are liquid or illiquid. Okay, so there are some famous ratios here. The first one is current ratio. Current ratio. So you see the name here, current ratio. It means we are comparing current assets and current liabilities. So the current assets is divided by current liabilities. So we use our hypothetical data here. Current assets are here, 2.6 million, and current liabilities are 1,039,000. Okay, so we get 2.58 for the current ratio. So see here how to interpret this number, this ratio, 2.58 times. Well, this is very easy. Even without any theoretical knowledge, you can see the calculation, the mathematical construction here. So current assets divided by current liabilities is 2.58 times. So we could imagine it this way. For every $1 current liabilities, you have 258 current assets. So current assets is 2.58 times the current liabilities, right? So once again, for every $1 current liabilities that you have to fulfill, or you're obliged to pay, you have like $2.58 current assets. So what is the meaning here? The higher the ratio, right, the higher the number, the stronger your liquidity position is. Be careful here. In accounting, we are very cautious. We are very careful in uh, deciding or in stating that a certain ratio is better than another. So we're not saying that the higher the number, the better it is. But it's more appropriate to say that the higher the number, the stronger the liquidity position of the firm is. So the stronger the liquidity position doesn't always mean a better indicator. You could imagine here, if you want to increase the ratio all the time, and based on the mathematical construction again, you could simply increase your current assets, and of course you could also decrease your current liabilities. But let's say you choose this one, you try to increase your current assets, you try to increase your current assets all the time to increase your current ratio. Of course, this will go that way, right? If you increase the current assets again and again, and the current ratio will uh, increase, right? Assuming that the current liabilities don't change. But imagine that if you increase the current assets, right? If you increase the proportion of current assets, think about it. Increasing the holding of current assets, of course, has some benefits, right? For example, you're more liquid. If you need the money, or if you need the uh, like cash equivalent items, you can get them easily. It's like, imagine that you hold your money and you put it under your pillow. If you put the money under the pillow, what is the main benefit again? You can get the money anytime, right? So anytime you need cash, you need to pay your bills, and you just need to get your money from under your pillow. But what is the disadvantage there? The disadvantage would be unproductive nature of current assets. Right? If you put your money under the pillow, the money uh, doesn't give birth to the next money, right? So it becomes less productive. So that's the weakness, right? So if you increase your current assets, that means that you're losing some economic opportunities because now you're holding something less productive. Okay, so not necessarily better, but the more appropriate statement would be the higher the current ratio, the stronger the position of the stronger the liquidity position of the firm. So sometime later, accountants found that the current ratio might not be that robust or that realistic to depict the liquidity position of a firm. Why is that so? Because here, especially on the numerator side. There are items here. There are items included in the current assets that are not really liquid, especially if you have like a difficult situation, right? You are in a dire need for money, right? A situation of hectic and again in dire need for money. Some of the items may not be that liquid. So you can give some examples like marketable securities, right? Some of them, uh, many of them are liquid enough, but some of them you have to check from time to time whether you can sell them quickly. Should uh, the need for money arises quickly, right, to your company. Maybe accounts receivable, right? Accounts receivable. Of course, in a normal course of time, you will collect your accounts receivable uh, like gradually, right? Maybe every month or every quarter or something like that. But in a maybe during a crisis situation, you might not be able to collect the money. And here's the problem, right? If in that situation you have like again dire need for money, right? You need to pay off some of your obligations while you have a difficulty collecting your accounts receivable, then you find a liquidity problem, right? A looming liquidity problem to your firm. Another item might be inventories. You can imagine inventories. In certain industries, inventories are quite easy to sell at any situation. So they're basically liquid, right, by any measure. You can imagine if you are a construction company, if you're a construction company, um, maybe some of your inventories are sand, cement, and some steel, right, or concrete or something like that. So a simple question, right? Under a difficult situation, yeah, any kind you can imagine any kind of difficult situation. Is it easy to sell like cement? The answer is yes, right? Yes, because cement is you could say relatively required from time to time. I know in a severe crisis, construction uh, will be declining, right? So the demand for cement will be lower. But in general, in any kind of situation, human will still uh, continue the construction, right, and repairing some buildings and everything. So this kind of example, like the cement, will be an example of a very liquid inventory. It has no problem, right, with this kind of inventory. But in some other industries, you could find inventories that are not really liquid, especially in a difficult condition. Maybe you can think about uh, hospital, right? Hospital or healthcare industry. If you if you own a hospital, can you imagine what inventories do you have? You have medicines, you have maybe needles, right? Needles for vaccines. Uh, you have some cotton, right? Cotton for procedures and everything. So can you imagine uh, in a crisis situation and you need like quick cash, how can you cash in your inventories? To whom will you sell the needles, the drugs, the medicines, and something like that? It's more difficult. Right? So in this kind of industry, those inventories are not really liquid. So they're questionable, right, in terms of the liquidity power to help the firm. Should a situation where the company needs quick money arises. That's why here, quick ratio, before we divide the numerator by the current liabilities, the current assets has to left out some items that are suspicious to be not that liquid. So in this example, only inventories are plucked out of the equation. But of course, in real life, you could take out any other items, maybe accounts receivable, prepaid expenses, or anything. So it's arbitrary depending on the context of your firm and industry. But in this example, again, this example only takes out inventories, right, from the numerator. So we recalculate again. So the current assets are 2.6, and we take out inventories. Right? In this example, only inventories are taken out from the current assets before we divide it by current liabilities. And we find 0.93 times 0.93. Again, this has a similar style of interpretation. For every $1 current liabilities that we have to pay, we have 93 cents of current assets that have taken out inventories. Okay, so the higher the number, the more liquid a firm is. So more liquid doesn't always mean better, right? So be careful in its interpretation. So if we compare the time series, you see the pattern there, 2.3 dropping position to 146 and then increasing to 258, or to 2019 at that time was still expected figure. And then the industrial average is 2.7. So you see here the firm's liquidity position is not as strong as that of the industry. Again, we are not saying that the company is worse off. We're just saying that the liquidity position is not as strong as the industry average. And similarly for quick ratio, we see the same pattern here, dropping and then increasing. And the industry average is quite close to the 29 or the expected 2019 ratio. So liquidity position is not as strong. So this is quite a dangerous word to use. I know it's weak, it's true, but just not as strong. So we are not saying that it's worse off. Okay, so those are liquidity ratios. So second category here, we have asset management ratios. So you see the name here, asset management. So we are gauging how efficient a firm is utilizing its assets, right? So how efficient a firm is using its assets, asset usage, asset efficiency. So we see first type of ratio included into this category. So inventory turnover ratio. This is a very famous one. So here's the thing. If you're talking about the accounting practices, in accounting we want accuracy and was it the rule-based estimation, right? So we really want the every ratio, every item is measured following the guidelines or the accounting standards or accounting rules, right? But there's a slight difference here with finance, right? So in finance, the decision making is more dominant, right? The decision making is considered more prioritized than the theoretical estimation. So see here, if you're an executive and you're talking about the making of financial decisions, you could safely use this principle. See here, if there's a word turnover, and the numerator is always your sales or revenues. So what is the denominator? The denominator would be what turnover is this? So here, inventory turnover, right? So the denominator is inventory. So this is the easy principle under the financial decision. So if you see the word turnover, then the numerator is always revenues or sales, and the denominator depends on what turnover it is. In our case here, inventory turnover, so the denominator is inventory. However, in accounting, the more appropriate estimation is like this one: the cost of goods sold divided by average inventories. So average, right? Because you see here, inventories are changing from time to time. So it could be that there's an extreme gap between the beginning value of inventories and the end inventories. That's why in accounting, we use the average inventories instead of the end inventories. But again, here it's quite relaxed because we're talking about the financial statement analysis under the financial perspective, not so much accounting in this case. But here, see here, the cost of goods sold, see here, what is the cost of goods sold? Is it 5.8? Yeah, so cost of goods sold, yeah, this one plus depreciation expense. So uh, today we are not talking about the accounting principles or accounting standards, but you know that cost of goods sold consists of the direct expenses, right? Also, costs directly related to the making of revenues. So if you have like a certain machinery that you use for making sales, right, for making products to be sold, then the depreciation expense of that machinery or such machinery um, has to be included as the cost of goods sold. So it depends on what kind of fixed assets, right? So cost of goods sold consists of costs directly related to the making of revenues, right? So some depreciation expense or depreciation expenses of some physical assets will be included into the cost of goods sold because those physical assets are directly related to the making of products, thereby being directly related to sales or revenues. Anyway, here we just use the cost of goods sold, including the related depreciation expense divided by inventory. So we get 3.45 times. 3.45 times. So this is the turnover, inventory turnover. So you could say that uh, within one accounting year, the inventory uh, is finished and then replenished 3.45 times. So you could imagine, right? So for example, I have this much inventory. So it's done, right? It's finished. What does it mean by being finished? It means that it's finished and it's finished to be a product, right? So turnover, the inventory uh, is finished or is made into certain products, right? And then replenish again one time, and then finish again, replenish again two times, uh, then finish again, replenish again three times. So 3.5 times, 3.45 times. So within one accounting year, the inventory is finished, right? Is converted or done or finished and replenished 3.45 times. So you could imagine that the higher the ratio, right? The higher the ratio, the more efficient the inventory management is, right? Because if you could you could turn your inventories over more and more. It means that you are very efficient, right? You're very efficient within that accounting year. But again, we're not saying that the higher the number, the better off the company. It's not necessarily true because you could imagine here, uh, if you want to increase the ratio, you could simply lower your inventory holding. So we discussed this more in the working capital management video, right, about the inventory management, but we can see it quickly here. If you want this ratio to be higher and higher, you could simply lower the holding of your inventories. And of course, there are some benefits uh, pertaining to that policy because now you could save the inventory cost, like or such as maintenance costs, the security expense, and some other storage related expenses. So you could be more efficient. You could lower the inventory costs, right, by holding a lower level of inventories. However, you can imagine, right, if you have a certain situation where there's a spike in demand, but you don't have enough inventories, then you have to rely on the quick order, for example, under the economic order quantity method or just-in-time inventory. You could you expect to hold inventory level close to zero, but should you need inventories, you could quickly order and the order will come on time as expected. However, in certain countries, you have to be careful because uh, the transportation and the traffic are not that friendly, not that comfortable or favorable. So you there might be a time lag between your order and the arrival of the inventories, and you might lose the opportunities to steal a higher level of demand due to the uh, you know, increasing demand situation. Who knows your competitors, right, are losing ground because of a certain problem, maybe uh, unhygiene problem with its products, right, or some uh, legal dispute, right, court settlement or anything. So you have the opportunities to steal the market share by harnessing the increasing demand quickly. But again, if you don't have enough inventories, you have to rely on your suppliers to supply the inventories quickly. So that would be quite uh, like taking time, right? So you might lose the opportunities. So here we can see the comparison, like time series is going down and then going down again. On the other hand, the industry average is much higher at 610. So in terms of inventory management, um, we could say that we are not as efficient as uh, the industry average. However, we are not saying that we are worse off. We're just not that efficient in terms of inventory management. Maybe we're holding uh, like a higher level of inventories, like a lot higher amount of inventories in this case. And of course, there are benefits and disadvantages from that policy. So next ratio is days sales outstanding, or you can call it average collection period, ACP. So days sales outstanding. So how do we estimate this? So your accounts receivable divided by sales, but the daily sales. So your annual sales divided by 365. See here, and check receivables 878 divided by sales, but the daily sales, so the 7 million divided by 360 or 365. So we get 45.5 days. So if you compare time series, you're seeing that the number is increasing. So again, day sales outstanding, imagine the name average collection period. So this is the uh, average period or average days you could collect your receivables, or the average days that you need to collect your receivables, right? So see the trend here is increasing. It means that you are getting more relaxed in collecting your receivables. So you're slower, uh, more relaxed, right? And maybe more ignorant, maybe, yeah, could be at some point. So you're slower, you're more relaxed in collecting your receivables. And again, we're not saying that the lower the number, the better it is. It's hard to say. But if you see uh, the industry average is only 32 days. And um, our ratio is 45.5 days. So we need, on average, 45 days to collect our receivables. So again, if you watch my video on the working capital management, you can see that this policy also has a dilemma, right? If you are doing such policy, like such as this company, where we are so relaxed and uh, not really pushy in terms of receivables collection, what are what is the main negative or disadvantage of doing this policy? Of course, the cash flows are slower to come in, right? Because you're slower in collecting your accounts receivable. So the incoming cash flow is slower, right? And uh, at an extreme case, some of your clients might run away because they know that you're not that persistent or not that insisting, right? In terms of the collection, right? Receivable collection. So you might not get the money quickly, or maybe you will lose the money altogether because they're gone, right? But what is the positive side of this policy? Of course, the positive side would be the good name, right? In terms of uh, you know market reputation. So there will be a rumor in the market that you are a good or a soft business person, right? So your previous clients might spread this rumor in the market saying that you're so kind, like you don't really push your clients to pay their receivables, right? Or they're payable to you, or you're receivable from them. So let's say you give like 6 months to pay, right? You're supplying something, and the contract says that your clients could pay within 6 months. But even over 6 months, you're not really pushy, but you're just smiling and something like that. So there will be a rumor in the market that you are a soft person. So there's a possibility that your sales will be higher because many potential clients want to do business with you, even on credit terms, right? They're willing to buy products from you on credit. On the other hand, if you enact or implement the opposite policy, now you're quite harsh. So you're a harsh collector, even with uh, one day of like lateness. You have sent debt collectors to your clients' offices or houses. So what is the benefit of this kind of policy? It's the opposite way, right? So most likely you can make sure that your cash inflows are arriving at the time expected. Right? So it's quite on time, right? Because you're quite pushy and even harsh. Right? You send out debt collectors quickly whenever a receivable is due. Right? So again, the cash flows will be quite timely. But what is the drawback of this policy? there will be, again, there will be a rumor in the market, you're a harsh person, and I think many potential clients would be hesitant, would be reluctant to do business with you, especially on credit. Of course, if they pay cash, it won't have any problem, because once you settle everything, the transaction is over. But for those people who want to do transactions with you on credit, they will be quite cautious. I could be quite reluctant, because they have heard a rumor that you are a harsh person in collecting receivables. Maybe even with some days of lateness, you have sent some severe or some scary debt collectors. Maybe those debt collectors graduated from Guantanamo or something like that. So you could imagine, it's quite scary. Okay, the next ratio under the same category here, asset management ratios. The next one is fixed assets turnover. So remember the principle that I told you just now. If you see the word turnover, then the numerator is revenues. What is the denominator? It depends on what turnover it is. In this case, fixed assets. Right, fixed assets. So turnover, the numerator is revenues, and the denominator is what kind of turnover it is. So in this case, fixed assets. So sales divided by fixed assets. You have sales, yeah, this one, sales. And then the fixed assets are 836,000. So we get 8.41 times. So how to interpret this? Okay, it's quite easy. Just following the mathematical formula here. So for $1 of fixed assets that we have, $8.41 are produced or are created. So again, for like, or you can say every $1 of fixed assets that you have could produce $8.41 revenues. So again, the higher the ratio, the more efficient you are managing your fixed assets. What about the other one, total assets turnover? Total assets turnover, again, you see the name there, turnover. It means that the numerator is revenues, right, turnover, and then the denominator is total assets in this case. So you see, check the numbers. Sales divided by total assets. Yeah, 3.5 million. And we get, yeah, 2 times. We get twice. Okay, so what's the meaning again? For every, or you can say every $1 total assets could produce $2 sales or revenues. Right? So every $1 of total assets could produce $2 of revenues. You see, it's an interesting fact here. See the symptom here, that when you calculate the fixed assets turnover, you get 8.41 times. But when you estimate the total assets turnover, you only get twice, 2 times. See the dropping of the ratio? So you can guess what is happening here. When we divide revenues by fixed assets, we get 8.41. But when we divide sales or revenues by total assets, we only get 2. It means that what's happening here? It means that the company has a lot of what? Current assets. That's right. Current assets, you can imagine. Right? Because the total assets comprise current assets and fixed assets. Right? So when you divide it by, we divide sales by fixed assets, you get 8.4. But when you divide it by total assets, you get only 2. So the symptom tells us that the company is holding a lot of current assets. It's very fat in current assets. Right? So we see here the trend going down and then increasing. Same here, going down and going down and down a bit again, right? Going down 2 years in a row. But you see the industry average here, 7. So in terms of fixed assets turnover, fixed assets management, we are not as efficient as the industry average. However, here we see that the sorry. Let me rephrase my statement. In terms of the fixed asset management, actually we are more efficient than the industry average. However, with respect to the total asset turnover, we are not as efficient as the industry average in managing the total assets. Right? See here, this one, again, the ratio is higher than the industry average, so we are a bit more efficient than the industry average in managing the fixed assets. But we are not as efficient as the industry average in managing the total assets. Okay, let's proceed to the next category here. The next category is debt management ratios. You see the name here, debt management. So these ratios indicate how able, right, or how strong a company could serve, right, its whole obligations. So you see, previously we saw the liquidity ratios that deal with a liquidity position or the ability of the firm to fulfill its short-term obligation or short-term liabilities. But here, debt management ratio, we are talking about the whole debt, especially the long-term debt, but also short-term debt that is part of the capital. So we're talking about debt that you take because of financing decision, right? Instead of operating decision like accounts payable or your deferrals. But other than your accounts payable and deferrals, most likely your other debts or liabilities are financing decisions that will affect your debt management position. So again, debt management ratios, they measure the ability or the capability of the firm of paying off its debts, right? Or you can call it like how well the firm is servicing its debt requirement or paying off its debts. So the first, so here's quite interesting here. We have debt ratio and liabilities ratio. And in the industry, we usually use this interchangeably, although they're not exactly the same. You see here, if you are a small and maybe smaller firm, you have your assets, you have your liabilities, and your equity. So uh, let me ask you a question, right? Liabilities and debt. So they are not exactly the same, but again, in a smaller company, there might be very close to 100% similarity. So let me ask you a question. Is that part of liabilities? Right? Is that here part of liabilities? And the answer is yes. Sure, right? The answer is yes. So if I reverse the question, um, is a liability necessarily a debt? The answer is no. So debt is part of liabilities, but a liability is not necessarily a debt. So for a smaller company, its liabilities might constitute almost entirely of debt. That's why we could safely inter use the terminologies interchangeably, right, between debt ratio and liabilities ratio. However, in a bigger firm, right, medium and big firm, I think we have to be more careful, because now you have liabilities, and debt is part of the liabilities. So we have other types of liabilities that are not debt. Maybe your uh, capital lease, right? And you might have minority interest, right? And some other things. So they're part of your liabilities, but they are not debt. Also your deferrals, your deferred expenses, right? They're your liabilities, but they are not really your debt. So you have to be more careful in separating liabilities and debt. For example, in this case, if you talk about total debt to as debt ratio, debt to assets ratio, this is 22.7%. But if you're talking about liabilities ratio, so the liabilities divided by assets, actually this is 43.8%. Okay, so you can imagine here, uh, this is talking about how much of your assets are financed by liabilities, right? So we call it liabilities ratio, or in smaller form, you can interchangeably use debt ratio. So this is 43.8%. So you could imagine what is the equity ratio here. The equity ratio would be 56.2%. Of course, right? Because your liabilities ratio is 43.8%. So we are saying that uh, uh, your assets are financed with liabilities by 43.8%. So for like every dollar of your assets is financed using liabilities of by 43 cents. Right? So every dollar of your assets is financed with 43.8 cents liabilities and 56 cents of equity, of course. Okay, so what is the interpretation here? The higher the ratio, the riskier the position of a firm. Again, we are not saying that the higher the ratio, the worse off it is. It's not true, or not necessarily true, but it's more appropriate to say that the higher the ratio, the riskier the firm is, because now you owe more money, right? Or you're financing your assets with more and more liabilities and less equity, so it's riskier. So let's think about using liabilities, or again we use it interchangeably with debt. Right? Debt. Let's let's assume, or just use an analogy of debt financing as eating meat. You can imagine, right, if someone is entirely not eating meat, it's like not using any debt. So what is the benefit here? Of course, you don't have a lot of thought because you don't have any debt, right? So you are debt free, you're more relaxed, maybe you are happier. I think you could sleep more tightly, right? So you sleep more tightly. But on the other hand, you eat uh, you eat less optimally because you don't have any debt, right? So again, if you don't eat meat at all, maybe you're freer, right? But what is the disadvantage? You are lacking in protein, right? You are lacking in what's that, the animal protein. And similarly here, if you don't use that at all, then you are lacking in the growth potential. Of course, right? If you decide not to use that at all, and let's suppose one day you have a very strong idea, have a good business idea, but you have the principle of not willing to use debt, then you have to wait until you have your own money, right, from the equity side. So you have to wait, right? You have to save and collect the money before you are able to execute your idea. However, here's the problem, right? Maybe when you get the money to execute the idea, the momentum has gone, or the idea has been hardness has been exploited by another firm, so the opportunity is gone as well. This is the potential risk. Okay, so we're saying that if we don't use debt at all, zero debt, then you might not be able to maximize your potential. Similarly, when you don't eat meat, you're lacking in like the protein, right? So when you start eating meat, when you start using that, your growth is higher. So you are healthier. Now you get the protein, right? Protein to improve your brain, to improve your body and everything. Similarly here, if you're a company, you start using that, then your growth potential could be more maximized, right? If you have a brilliant idea, you could simply execute the idea because you have the borrowing. Right? However, see here, at some point, right? At some point, if you continue to use that, then actually this is counterproductive. Similarly, right? When you start eating meat, you're healthier, you enjoy the protein, so your body grows healthily or healthier. But up to a certain point, if you keep eating meat, then this is dangerous to your health. That is damaging your health. And similarly here, up to one point, we call it like optimum debt level, optimum capital structure. If you keep using that, then it's dangerous. It's dangerous. It will bring damage to the financial position of your firm. Okay, so again, the higher the debt ratio, the higher the liabilities ratio, the riskier the position of a firm. But a riskier position doesn't always mean a bad thing, right? Because you could improve your growth potential by increasing your debt ratio. So next one, this is a good name here, times interest earned, and we call it a tie. You can imagine a tie, your tie, right? When you wear with your suit, right? Your tie. So basically, this one tries to measure how chopped you are, how how chopped you are. See how the name is good, right? So at the choking that you are suffering, right, because of the debt that you are using. So again, times interest earned wants to uh, assess wants to gauge how chopped you are with respect to your debt financing. And here we could see here uh, operating profit or earnings before interest and taxes divided by your interest expense. So let me show you here again, repeating a little bit. You have revenues, you have cost of sales, cost of goods sold. So this is your gross profit. And after gross profit, you have operating expenses, right? Indirect operating expenses. Operating expenses like salary expense, right, for employees and executives. You have marketing expense. You have yeah, whatever other expenses, general expense, including here we have depreciation expense, depreciation and amortization expenses. And then we might have what else? Lease expense, lease expense. And then yeah, maybe some other types of operating expenses. And if we deduct all of the operating expenses from gross profit, you'll get operating profit. Operating profit, and then you deduct the other incomes or losses. right? Could be plus, could be minus, right? Other incomes or losses, then you get your earnings before interest and taxes. And then afterward, immediately you will deduct the interest expense. That's why you see the ratio here is earnings before interest and taxes divided by interest expense. So we want to know how strong your EBIT could cover your interest expense, because interest expense is immediately an item immediately after the earnings before interest and taxes. And we find out here is 6.3 times. See here, check the number. EBIT is here, interest expense is here. So we get 6.3 times. So every $1 interest expense could be covered by $6.30 earnings before interest and taxes. So the higher the ratio, the more able your company is in covering the interest expense. So again, the higher the ratio, the more able the firm's EBIT to cover the interest expense. Then we have EBITDA coverage. I think this is one of the major indicators used by a bank to assess the creditworthiness of a potential borrower. So you see a lot of plus here, depreciation and lease payments uh, divided by interest expense plus lease payment plus loan payment. Okay, so why are they doing like plus here and there, and then divided by something plus here and there? And even here, you see the same thing. Right? You see the same thing here. Okay, so this is the logic. Let's come back here. Okay, so to make it easy, we will assume that we have no other income and losses. Okay, so there's no other incomes or losses. So immediately here is EBIT. Okay, again, we don't have any, we don't have other incomes or losses. So the operating profit is immediately the EBIT. So if I'm here, let me give you an analogy. If I ask you a question, if you stand on the ground floor, right, a ground floor, and you look at a field, whatever field it is, a soccer field or anything. Compare it with a situation where you go to the first floor, right? You go up there, you go to the first floor. First floor in this context means you go upstairs, right? Go to the one level up. You go one level up, and you see the field. Which one will give you a clearer panoramic picture? Of course, the one level up, right? So the first floor can give you a more comprehensive picture, more panoramic picture than the ground floor. So similarly here, if I see the EBIT, if I plus lease expense, so I will be here. I'm going upstairs, right? If I add depreciation, then I go upstairs again. So now I'm here. Let me use another color here. Now I'm here. Once again, see, from EBIT, if I plus lease expense, I'm going one floor up, right? One level up. And then if I add depreciation expense, I go to an upper room, so upper level, right? So I'm here now. So the question is, when I'm here, I want to see the company's ability to pay this one, okay? And then what else? Okay. Oh, after this one, interest expense, right? This one, right? Now you understand what I'm saying, right? So once again, I'm EBIT here, my EBIT position. If I go up one level by adding lease expense, by adding back lease expense, I'll be here. If I add back depreciation expense, I will go one more level up. So I will be here. So when I'm here, I want to know the company's ability to pay its lease expense in its interest expense. Okay, so now you understand why we add here and there, divided by something we add here and there. So EBIT, right? Go upstairs, go one more level. So you are in the upper position now, and you want to see at this position, whether the company could fulfill its how strong or how able it is to fulfill its interest expense. So here, right, interest expense, and then lease expense, and loan payment. This is a principal payment. You cannot see the principal payment on the income statement, but you have to go to the cash flow statement. Right, the principal payment, the cash flow from financing activity. Right, so again, we want to know, right, at this position, how well the firm is servicing its interest expense, lease expense, and the principal payment of its borrowing or its loan. This one cannot be seen on the income statement, but you have to go to the cash flow statement. And we find out that it's 5.5 times. Okay, so let's see the comparison here. I'll start using this one, the liabilities ratio. Let's assume that the debt ratio, of course, they're different, but again, for the sake of brevity, right, for the sake of our current analysis, we just simply focus on liabilities ratio as a whole, right? So you see the trend here is it increased sharply in 2018, but went down again in 2019. And the industrial average is actually 50%. So uh, in 2019, the company was not employing uh, as much debt in terms of its ratio to total assets, as much debt, as much proportion of debt as that of the industry average, because the industry average is using like 50% debt ratio or liabilities ratio. So this being the case, actually the company still has a room for maneuver, right? The debt capacity that could be used someday, well, sometime later, should it have good project potentials. In times interest earned, the tie ratio going down and then going up, and the industry average is 6.2. So actually, the company is quite quite able, right, with respect to its ability to cover, or its operating profit to cover the interest expense. But when we measure the EBITDA coverage, is not as strong as the industry average. Remember the EBITDA coverage, the ability of this position to for the firm to service or to fulfill its interest expense, lease expense, and principal payment. So not as strong as the industry average. Okay, so the next ratio, this is famous category, profitability ratios, and it's very easy to guess, right? So how strong the firm's capability of like generating profit, right, or earning profit. That's why we call it profitability ratios. And we have a famous ratio like profit margin, the net profit margin. Profit margin is the net income divided by sales. So the bottom of the income statement, yeah, bottom of the income statement divided by the top of the statement. So we get yeah, 3.6%. That's 3.6%. So imagine uh, so every $1 sales or revenues could produce 3 cents, 3.6 cents net income. So the higher the ratio, the more profitable the company is. Right? So you see the number here is typical American company profit margin is not that high, but in other countries, especially in developing countries, you'll find the profit margin could be maybe more than 10%, right? Maybe more than 12 or something like that. But in the context of United States, it's quite hard to push your profit margin because of the competitive industry. So 3.6%. What about operating profit margin? The operating profit, we can use operating profit or we can use EBIT, right? So because we are estimating the operating profit margin, the numerator is not net income but operating profit, or you can simply use EBIT if you don't have any other income or losses. So see EBIT here, 502,000, and sales is 7 million. Okay, so you find out that your operating profit margin is 7.1%. What does it mean here? Every $1 revenues could produce 7.1 cents of operating profit. And we could also estimate the gross profit margin, right? Gross profit margin. So gross profit, so what is it again? Gross profit. Remember here we have gross profit. The gross profit is the difference between your revenues and your cost of sales, right? So in this case here, your revenues minus your cost of sales or cost of goods sold divided by sales. So this is called gross profit, right? Remember, this is gross profit. The gross profit margin is 17.6%. So what's the meaning here? For every $1 revenues that you generate could produce 17.6 cents gross profit. Once again, right? Every $1 revenues that your company earns could produce 17.6 cents gross profit. So what is referring to the number here, what does it imply about the cost of goods sold or cost of sales? So the ratio of cost of sales to revenues is 82.4%. This is very high, right? You could imagine your cost of goods sold uh, constitute 82.4% of your revenues. So your gross profit margin is only 17.6%, right? This is quite low, but again, a typical example in a competitive country. See the trend is going down and then improving, and see the industrial average. Actually, the net profit margin is comparable, and so is the operating profit margin. And even for the gross profit margin, actually this company is enjoying a higher gross profit margin. It's relatively more profitable with respect to the gross profit, right, than the industry average. Next one, basic earning power. I think I will skip this one because the more appropriate name for this one is actually ROA, right? So ROA is a famous ratio, return on assets. So we use this a lot in research, in industry publications, right? Something like that. So ROA is return on assets. Here's the thing, right? Again, we see a slight difference here between accounting and finance, right? Of course, it's in some aspects. In accounting, we want like more standardized calculations, right? According to, again, the rules, according to the principles. But in finance, is like more free, right? It's more flexible. You can see here this one. If we estimate net income to total assets, I'm not saying that this is wrong, but in accounting, this is not really robust, right? Not really robust. I'll show you why. Let's imagine you have uh, two financial statements, right? The two reports. The first one is your balance sheet. So let me ask you a simple question. Who have claims? Who have claims to your assets? Who have claims to your assets? Of course, your creditors and your owners or stockholders. Right? Once again, right? Who have claims to your assets? Your creditors and your stockholders. Right? Or maybe I use the blank, easier. Yeah. So who have claims to your assets? Your creditors and your stockholders. So now let me ask you a question here. Who have or who has a claim on your net income? Who has a claim on your net income? Only your stockholders. Okay, so you see, comparing comparing net income to total assets is not that appropriate because we are, this is not apple to apple. You could understand what I'm saying, right? Net income belongs to stockholders. Total assets, total assets are claimed by creditors and stockholders. So surely in accounting, this is not that robust. That's why I'm saying, again, in finance, this would be okay, right? Because in finance, decision making is the foremost priority, right? Not the accounting principles or standards. But if you want to do it more correctly in accounting, this should not use net income, but we have to use the operating profit or at least EBIT. Right? Why? Because you see here, who have claims to EBIT? The creditors and the stockholders. So now they are equivalent, right? They are of the same level. So who have claims to EBIT? Creditors and stockholders. Who have claims to total assets? Also creditors and owners. So the more appropriate one would be EBIT to total assets. But of course, if you want to calculate net income to assets, that would be okay in finance. Okay? Because again, fast decision making is preferred in finance. Okay, so let's assume that this is EBIT. Okay, so to make for the sake of brevity, so let's assume that this is EBIT divided by total assets, so 7.2%. So again, what is the meaning here? Every $1 total assets could produce 7.2 cents operating profit. Again, pretending that this is EBIT, okay? Assuming that this is EBIT and not net income. So every $1 total assets could produce 7.2 cents EBIT. Of course, the higher the figure, the more profitable your company is, right? And here's the pair, return on equity, ROI, return on equity, return on equity. Now, look at this carefully. If we say that return on equity is, we measure ROI as net income divided by equity. Let's check, right? Net income, who has the claim to the net income? Claim on net income? Stockholders only. Agree, right? Only stockholders have claim to not net income. Who has a claim over the equity? Also stockholders. So this is correct, right? This is accurate. So return on equity can be measured as net income divided by your equity. And here, net income divided by your equity. Check the number quickly. Net income and divided by your equity. 12.8%. So you see, for every $1, or let me rephrase my statement, every $1 equity, I could produce 12.8 cents net income, right? So every $1 common equity could produce 12.8 cents net income. You see the trend here. It was plunging, right? It plunged in 2018, but then improved. They came back in 2019. See the industry average here, both are higher, right, for ROA and ROI. So in terms of ROA and ROI, the company is not as profitable as the industry average. So next category next category of ratios, market value ratios. Actually, these ratios are more related to stock valuation, because we're talking about market value. Market value, right? When we talk about market value, this is tied to the stock market, right? Because that is, I think, the more, I would say, the most objective, was that most objective measure, right, or indicator of value. For example, if a company is not a listed company, meaning that it is a closely held corporation, we can only hire, for example, an appraisal firm, right? An appraisal firm to officially assess and do the valuation. But of course, it has a lot of subjective assumptions and also estimations in the valuation. However, if a company is listed on a stock exchange, then the stock price will go up and down, all the time, and that reflects the market value, right? Because it depends on the demand and supply based on the buyer and seller expectation. So market value, right, the stock price multiplied by the number of shares outstanding. So again, these ratios are highly related to the stock valuation, actually, and not really related to the accounting books of a firm. But let's see some of them. The famous ones. Let's say the stock price is 12.17, and see here EPS. It stands for earnings per share, right? Earnings per share. So what is earnings? Net earnings or net income divided by shares, right? Number of shares outstanding. So in this case, what is our EPS? Again, the net income divided by the number of shares outstanding. So 101, right? And we have a ratio here. PE is price to EPS. So price to earnings. Because the stock price is always per share, so the earnings here should be per share as well. That's why we calculated EPS previously, right? 101. So price to earnings, again, because the stock price is always per share, then the earnings should be per share too. And we find it's 12 times. So this is an important indicator of in relative valuation, right? So price to earnings ratio. So the higher the ratio, the higher the growth potential. So uh, if the P ratio is relatively small, we are saying that the company might be a value firm, but not a growth firm anymore. But if the pair is increasing and at some point it has become so high, uh, we could say that the risk of holding that stock would be quite high as well because the pair or the P ratio is already too high. So it has like two-edged sword, right, in terms of its analysis. And then we can calculate the cash flow, simple operating cash flow here, net income plus depreciation. So the rough or the raw estimation of operating cash flow divided by shares outstanding. And you could estimate also price to cash flow, stock price divided by cash flow per share. So there are a lot of ratios that you could actually use as your market ratios or relative valuation. So book value per share. So book value is the common equity recorded or written on your balance sheet. Here is on your balance sheet. So different from the market value that relies on market stock price or the stock price. But here book value means why we call it book, because which book is it? The balance sheet, right? On the balance sheet. So the value of equity here, book value of equity on the book, on the balance sheet divided by the number of shares outstanding. So 791. And the interpretation would be the same as what we did before. So every share has a value of like $7.91 of the equity on the balance sheet. And here, this one is also a famous one, right? So we have two famous ratios here, PE ratio or pair, price to earnings ratio, and market to book ratio. So market value, again, this is market price, right, on a stock exchange. So the stock price on the stock exchange divided by the book value per share. Again, book value per share is the value of equity recorded or written on the book, right? So what is the book there? Balance sheet, right? What book is it? Is balance sheet. So equity value on balance sheet divided by the number of shares outstanding. So here, market, because the market value per share is the price per share, right? The market value per share is the stock price, and stock price is always stated per share. That's why when you divide by book value, this book value has to be per share as well. The market value per share divided by book value per share. So 1.5 times, you could imagine, right? So the value of equity, uh, the stock price or value of the equity in the market on a stock exchange is 1.5 times, 1.5 times the value of equity on the balance sheet. Okay, and you can see the trend from time to time. Because again, this is market ratio. So we need to use the value on the stock exchange. So industry average is higher in terms of P ratio, price to cash flow, and also market to book. But sorry, for the price to cash flow, actually we have a higher figure here, higher ratio of price to cash flow, but price to earnings and market to book, we are below the industry average. And you could do the common size ratios, common size. For the balance sheet, common size means every item is compared to total assets. You see here. Total assets. So we want to know, for example, assets. What is the proportion or percentage of assets compared to total assets, and short-term investments, accounts receivable, and so forth. Right? Similarly here, for every item on the right-hand side of your balance sheet, you find the relative proportion of that item to total assets. Right? So again, the common size for common size balance sheets mean that you find the proportion of every item to total assets. What about the common size income statement? Common size income statement means that you find the proportion of every item on your income statement to revenues or to sales. See here, right? The sales 100%, and cost of goods sold. What is the proportion of cost of goods sold to sales? 82%. Depreciation expense, operating expenses, interest expense, and so forth until net income. So you see the difference here. Common size balance sheet means that you find the proportion of every item to total assets, but for common size income statement, you find the proportion of every item to revenues or sales. Okay, so to end our discussion today, we want to see the all categories, right? Especially the first four. We have the liquidity ratios, we have asset management, we have debt management, we have profitability, and the next ratio, market ratios, are a bit different, right? Because it is related to the market value or the stock price on a stock exchange. But you see the four here, accounting, basically accounting ratios. So you can think about these categories as a comprehensive or a whole unit in like maybe a soccer game, a football game, and see liquidity ratios. Again, they are measuring the ability of a firm to fulfill its short-term liabilities. So it's more defensive. So you can think about like the defender position, defender or back, right? Defender position. Then the asset management and debt management ratios are like the measuring the flow, right? The efficiency, the flow of the ball, right? The football game. So these are equivalent to the midfielder position, right? Midfielder position. So they have to, improve the flow of the game to make sure that, from defensive end to the offensive end, they are connected, right? And they are smooth. And of course, the profitability ratios are attacking, right? So this is equivalent to the striker position. So it aims to score, right? To score goals, right? So again, this is like synonymous or equivalent to the striker position. So how to incorporate all the ratio categories into a more synchronized or uh, connected analysis. So there's a famous company named DuPont, right? DuPont company. You know, this is a French name. So obviously the founders came from France, right, in the past. So DuPont, right, a chemical company, uh, is having a famous DuPont analysis, right, that connects uh, all sorts of ratio together or representatives of each category. So let's think about this. If I talk about ROI, right, return on equity, I hope you still remember what we just discussed, right? ROI, how to estimate ROI again? Net income divided by your equity, right, on your balance sheet. So if we simply look at the ROI of a company, you find out that the ROI is like above or below the industrial average, but you never know like the deep or deeper cause, right, or causes of this fact, right? You can say the root causes of the higher or lower level of ROI compared to the industrial average. But by doing or by breaking down the ratio into several components, we are able, we are more able to see, the components. Right? The first component is profit margin, right? Net profit margin. How to estimate net profit margin again? Net profit margin is net income to revenues or to sales, right? Okay, and if we multiply this by total assets turnover, remember the principle again? If you see the word turnover, then the numerator is sales. So what is the denominator? It's total assets, right? Because this ratio is total assets turnover, so the denominator is total assets. If we multiply it again with we call it equity multiplier. So equity multiplier is actually the debt ratio, but it's taking another form simply to uh, to make it possible, to delete the numerator and denominator. Uh, so we use the equity multiplier to represent the debt ratio, so that we could nicely, arrange the components mathematically. Because how to measure equity multiplier? This is total assets to equity. So we'll prove it, okay? Total assets to equity actually represents the debt ratio. You can imagine if I have this, so assets divided by equity, right? Assets divided by equity. So if I increase, let's assume that I increase the proportion of equity, right? If I increase the equity, then this ratio would be what? Would be lower. Agree, right? If I increase the proportion of equity, then the equity multiplier ratio will be lower. And let's prove it, right? If you increase the proportion of equity, of course the proportion of debt is lower. So it's the same, right? It's equivalent. So it's heading into the same direction. What about if I do it differently? Now, if I increase, or if I decrease the proportion of equity, here, total assets divided by equity. If I lower or if I decrease the equity, then this ratio will be higher. The equity multiplier will be higher. And let's prove it here. If I lower the proportion of equity, that means that I'm increasing the proportion of debt, similar to what this ratio shows, right? Higher equity multiplier means a higher debt ratio. So again here, uh, where we represent the debt ratio using equity multiplier, so that we could nicely arrange this mathematically, right? So the end result is net income to equity, which is the ROI. So by using the components, now you can see profit margin represents what? Profitability ratio. Total assets turnover, this is asset management ratio. And equity multiplier is debt management ratio. So all ratios are represented here. And we'll see an example, simple example here. See, for example, in 2019, the ROI of, our expected ROI is 13%, which is below the industry average of 18%, but we never know, right? We never know what affects the ROI, what makes a difference, right? And by breaking the ROI down into several components based on the Dupont method or Dupont equation, we find out that the profit margin, the company's profit margin is the same or equivalent or comparable to the industry average. So there's no difference here. But you see this one, total asset turnover of the firm is below that of the industry or the industry average, meaning that the efficiency of managing total assets is lower, right, for the company compared to the industry average. This is one of the big point here that that renders the ROI lower, right, for the company. And also this one, in terms of equity multiplier or debt ratio, the company is using a lower level of debt in 2019. Right, so lower debt ratio, meaning that lower growth potential, because you are using a lower proportion of debt to harness the like potential projects or anything. So lower debt ratio means you are less aggressive. You are less aggressive than the industry average. So these two components actually affect the ROI of the company. That's why the end result here, the ROI of the company is lower than that of the industry average. So now we know that the asset management efficiency is not as strong as the industry average, and the use of debt, right? The use of debt financing is also lower, so it's not as aggressive as the industry average. Okay, so we have seen and discussed financial statement analysis again in a general framework, because if you want to discuss the more technical type of analysis, we have to go through the deep accounting courses, where we have like symptoms, we have root causes. Yeah, maybe sometime later I will make a video on more thorough and deep financial statement analysis. I think sufficient for our discussion right now for the financial statement analysis. Thank you for watching and see you again next time.